Hey, what is happening? This is Maxim Cruz, your real estate broker during all cycles, coming to you from Miami, Florida. So, last week you might have seen that I posted something about a look at Miami's hot multifamily market. Now, this was a report, an article that was done by wealthmanagement.com. Now, if you're in any sort of investing, doesn't matter if you're in real estate, business, stocks, cryptocurrency, whatever you can think of when it comes to investment. This is a resource that I highly suggest. When you go on wealthmanagement.com, they have different things. There's things for medical, there's things for very niche specific businesses, and then they have sections for stocks, bonds, NTFs, real estate, everything that you can imagine. So because I'm in the real estate industry and because I'm in the kind of the financial market industry, I subscribe to two things. One is kind of their business outlook, and two is their real estate, and some of the things they talk about is specifically investment or commercial. So again, wealthmanagement.com is a great resource for you to utilize, for you to check into, and just stay on top of what is happening in the industry. So always I've learned that it's important to think about biases, right? Because an individual like myself, who's a broker, also an investor, I'm going to be biased towards the performance of real estate, and I have to recognize that. So the same way, this institution or this company, wealthmanagement.com, they're a publication and their primary target is investors and also investment counselors, whether you call them brokers, whether you call them financial planners, whatever. So they want to publicize certain news, which then those bankers, those brokers, those individual financial experts or advisors can go in and say, hey, did you see this article that came out? This is why it's a great opportunity to invest in, I don't know, bonds or whatever based on this. So again, just looking at that as a bias, I'm looking at this from a very objective point of view, and I'm saying, okay, what is really happening? Is it that Miami is truly a great market to invest in multifamily, or how can I look at some things? So I always want to double check. So let's go in and take a look at this article together about what I'm talking about. So I'll have the link here, but pretty much it says a look at Miami's hot multifamily investment, and this was published September 20th, 2022, and it goes in there to say, hey, the rents in Miami are growing, increasing the value of Miami apartments, just not as quickly as past years. And what I'm going to do here is I'm actually going to show you some resources that we as brokers have access to. And again, you have to interpret information. I greatly value an individual that once taught me, look, sometimes back of the napkin or the yellow pad evaluation is the best way for you to do it, because you could come up with a million different stats and you can manipulate them in certain ways. But if you look at things in the back of a paper, you'll kind of realize what's going on. So going back to the article, it talks about the years of the coronavirus pandemic, the recovery, the millions of apartment renters that moved from different cities, and everything else that was going on. So essentially what it got into was, hey, the construction costs are expensive. Also, Miami is kind of landlocked, where obviously we have the Atlantic Ocean to the east, or South Florida in general, let's put it that way. Have the Atlantic Ocean to our east, and then we have the Everglades, which is a conservation environment, to the west. So you have this kind of narrow rectangular stretch of land that is limited to what you could build. And obviously you have people from all over the place that throughout the pandemic have come here. So again, it talks about the economy and what's happening. Major players coming in and buying great buildings, and it's a combination of local taxes, great weather, business-friendly environment, entrepreneurs, technology. There's a lot of things that have been driving this market to come to Miami, right? And then finally, at the end of all this, it looks like saying, hey, they have all these statistics for what people were buying, the cap rates, all of that stuff. But at the end of the day, one of the things that we kind of look into is, another example here, 22.9% rent growth begins to moderate. So it's pretty much saying everything has been continuously going up, up, up. So now the question is, now that it's starting to stabilize and go on a more linear path, what is happening to specifically an investment when you look into, okay, putting X amount of dollars in, expecting X amount of dollars out, and how you're evaluating that. So let's take a look at some statistics that I was able to do. So what did I do here? The first thing I did was I did a map search, and this map search right here, pretty much I wanted to look into the rented units in this highlighted region here. So I focused kind of south of Fort Lauderdale, going all the way down to Homestead, and kind of in that rectangle. And these are all of the rental units. So I did multiple statistics. So the first statistic that I did was this one right here, which actually looks at residential rentals, and it goes back to 12 months. Now, again, the most important thing which I want for you to look at here are these two figures, the current 3 months and then the prior 4 to 6 months, and then where we were about 7 to 12 months ago. So, for example, 7 to 12 months ago, we had active listings about 3,081. That was the number of listings that was, being consumed. So the prior 6 months, the total, sales, if you will, the total number of apartments that were rented was 9,914. In the last 3 months, it was 10,986. So the other thing that's important to look at here is the absorption rate. How many apartments are renting per month? So here we come to 3,304 in about the last 6 months. In the last 3 months, 3,662. So you kind of get this 3,300 figure per a quarter that is being rented out. So when I take a look at the active listings and I see, hey, today in the market, there's 10,142 active. In the prior 6 months, the comparable sales was 2,475. So essentially what we're trying to look at here is how many apartments are coming onto the market, how many apartments are currently available, and understanding if we're renting out roughly 3,000 apartments per month. If we have 10,000 apartments available to rent, that's a 3-month supply. So at a rate where people are, renting this stuff, how fast are we going to be able to go in and rent this stuff? So again, there's a lot of way to interpret this information, but ultimately what's important is to say, hey, why are people coming or emigrating to a certain area and what is going on? So a lot of the people that are coming into South Florida are actually coming with remote work. A lot of companies are also moving to South Florida, and that's why the investment has started to increase. And you're always going to have this balance between supply and demand. Anytime the supply is less and the demand is higher, number one, that is going to drive prices up. And then obviously you have less supply, so people are going to be kind of struggling to find this place. Anytime you have less demand and more supply, that is like, okay, from an investment point of view, does it make sense to go in and buy more of something where something is readily available, or do you want to buy a more scarce asset that might be able to produce a higher return because the demand is high but the supply of that asset is low? And that's really what this article was continuing to talk about. And what's funny is, during the last 9 months, obviously we've had a great variation of interest rates, and it's going to continue that way. But the other thing when it comes to interest rates, when it comes to investing, is don't look at interest rates in a 3-month or 12-month or even a 5-year period. Go back in time and look at history. Look in the 1980s where it was above 20%, and look at the amount of development that happened right before and right after that. So anytime you're evaluating an asset, yes, it's important to consider interest. It's important to consider what your expenses for money is going to be, but understand that interest rates go up and down, And specifically, some investors have taken a very, I would say, aggressive approach and have bought at lower cap rates at higher interest rates, with the understanding that because the supply is low and the demand is high, they can afford to have a lower return on their investment initially today because of the higher interest rates, but understanding that when they refinance, let's say 12 months, 24 months, 36 months, as long as they can cover the debt service during that 24 to 36 month period, when the interest rates go down or start to adjust in a more favorable way, they have the option of refinancing and then at that point lowering their capital expense and now increasing their return on their initial capital. So again, there's multiple strategies that you could discuss. Everybody is different. I've met with all sorts of different investors who are very, very conservative and some that are very, very aggressive, and everybody is different. That's all I could tell you. So I'll put the link in the article here below if you want to go and read it and check it out. And again, for example, for right now, for what my wife and I are doing in our personal portfolio, we personally are not investing in the South Florida market. The reason is because we can get better returns in other parts of the country, and a lot of other investors would agree with me. Some investors that have a lot of capital or that have a lot of equity that they want to put into a market where they can hold this asset and really not care that much about performance. For example, some private equity funds and some hedge funds, how do they make their money? The administrators of those funds make their money on acquisition, disposition, and the management of the asset of the portfolio. To them, whether the investor gets a 4% return on their money or an 8% return on their money, guess what? They're still going to get paid their fees for acquisition, disposition, and management. So that being said, in some scenarios, they're not that motivated to get the investor the best deal. Of course, they lack the foresight of saying, hey, if my investors can get a better rate of return at another fund, guess what they're going to do? They're going to slowly start pulling their money out and investing with somebody else. That's a possibility. But again, everybody is different. So understanding that investments is a broad world. Investments can vary. Everybody has a different strategy. Everybody has a different why. There is no rule that says, hey, the magic number that you want to get for return on your investment is the rate of inflation plus 1%. Some people don't make any investments until they get a 10% return on their money. And what they'll do is they'll stockpile cash, and they'll sit on this cash. And when they come to their investment, then they'll go and double down and put all their cash in one thing. And that's how you see their portfolios kind of, take off in a trajectory, a hockey stick trajectory, versus some other ones are more in that kind of up and down, riding the wave, 4 to 8 to 12%, wherever you want to be. And then they're consistently getting that line of positive return on their investment. So let me know if you liked today's video. I'm going to continue to post information here. If you're new to this channel, go ahead, like and subscribe, and I look forward to seeing you on the next video. Max Cruz checking out.